Hey guys, so in this video, I'm going to be discussing the stock market. I know I've thrown a lot of shade on the stock market in previous videos, but it still remains one of the most used investment vehicles in this country, in the US, to create millionaires. Um, I have funds in the US stock market because there's a ton of wealth to be built from the US stock market as well. And understanding how you can make money and lose money and how it all works and ties together is a great part of your total investment portfolio strategy. Like, that's something that you should add to your strategy, something that you should invest time learning, and something that with the right professional financial advisor, you can create a stable, long-term wealth building plan. All right. So to dive right in, a stock. A stock is an ownership equity in a company. So when you go to buy a stock, right, you're looking at more than just what the numbers tell you. You want to look at the company itself, the company values. It's almost as if you are purchasing a company. And this is how I like to illustrate it in the standpoint from the standpoint of risk. Okay, let's say you were going to go buy a 7-Eleven, right? You wanted to buy a 7-Eleven that you were going to put on the corner of your housing district, and that was going to be your principal business. Now, if you were going to do that, you would research 7-Eleven in general, the company. You would find out how profitable they are, what sort of innovations do they have within their industry, what does their industry look like long term, what are the pros and cons of purchasing this company, location wise, like what are the advantages of the location. You would go into a lot of research on bigger picture dynamics of that company, right? You wouldn't want to buy a 7-Eleven, gas station if the entire country was converting to electric cars, for example, right? So, in the same way, when you go to purchase a stock, you are buying a piece of a company. You own that company now. And the way that I approach it, if I'm going to own a company, I'm going to want to understand more about the company. And that kind of changes how you approach investing. When you go to invest in stocks, you are purchasing pieces of companies. So how you research that company and how you research that industry should be taken more into consideration. Um, yeah. So that's what a stock is. Now for a bond, maybe you're familiar with what bonds are, perhaps not, but a bond is basically a loan that you as an investor give either a government agency or a company, right? So let's say a municipal bond, for example, like if your city sold bonds, they like if they wanted to raise money to build a park or something, right? You give them a certain amount of money, and then the bond has something called a coupon rate, which is the interest rate that you are guaranteed to get from them, and then they will pay back the entire principal value of the bond at the maturity date. So you're pretty much loaning money at a coupon rate, a guaranteed rate that you are expected to get the entire principal amount back at maturity. Now, a government entity is a very stable, considered a stable uh, entity to lend to. So typically, the coupon rate from a bond to a government entity will be lower. So you yourself will earn a lower interest rate because of that stability. But if a company were to issue bonds and they have the possibility of going bankrupt and then you not getting your money back, they would have a higher coupon rate because of that inherent risk, right? Now, many financial advisors recommend adding bonds to your portfolio because, again, it's not all about the upside of making money. It's also about protecting your nest egg on the downturn. So whenever the market crashes or goes the other way, there are certain investment strategies that your financial advisor could put in place to help minimize the downturn of your entire portfolio. All right, and bonds are typically a way that they recommend doing that. And here's why. Typically, bonds and stocks move in opposite directions. Okay, and this goes a little bit into the economics of how our country works, but pretty much as stock prices increase, right? Revenue goes up, stock prices increase, there's more money in the economy. Typically, in order to combat inflation, you raise interest rates, right? As you raise interest rates, that slows down people's ability to purchase and keeps inflation in check. Now, the bond rates are competing with interest rates. Typically, a bond rate will be slightly higher than interest rate because how are they going to convince you to loan them the money when you can make more money elsewhere, right? So if you purchased a bond, let's say this year, and they're offering you a 10% interest rate, but then interest rates rise over the next 5 years. So in 5 years, they may be offering 15% for the same amount of money. So in essence, your bond would have lost value in terms of how much interest your money could have been earning. It's more of an opportunity cost, right, that you lost. That's kind of why bonds and stocks sort of move in opposite directions. Now, the bond value itself can be affected from deflation, right? So as stocks and everything starts moving in the opposite direction, the bond value can start increasing from that point. So all of that basically to say that that may be part of your financial advisor strategy, and it's a good thing for you to learn about as well, is to help that in the event of a downturn market, having bonds there to help stabilize your portfolio can help minimize the losses. Because anytime that you lose money, let's say you lost 50% of your portfolio, you would have to get 100% ROI just to start getting back to where you were. So minimizing your losses is as important, if not more important, than getting those gains. You know, it's better to get consistent, steady gains and then minimize your losses than to get huge gains but then have huge losses as well. All right, so now to go into long-term investment strategies, and these are products that you could purchase that are stock market type products, right? And so one of them is ETFs. We're going to talk about ETFs, index funds, and mutual funds, all right? So an ETF is an exchange-traded fund. These funds can be a blanket of stocks within a certain sector, and basically the management fees for this type of account are very, very low. So it kind of offers an alternative to having more than one stock in your portfolio. So let me give you guys this example, this analogy. An individual stock would be like, imagine you're in an elevator, okay? And you are being held by one wire all the way up, okay? So at that point, with that individual stock, even if it's a very awesome, robust stock, you still have one, and that is the amount of risk you have in your elevator. Now, if you have an ETF or if you get index funds or mutual funds, this is like taking stocks from multiple sectors, from multiple areas and a bunch of different stocks, and then putting them all into one product. So if you bought a mutual fund, right, or bought an index fund, it will have multiple companies from different sectors. And what a sector is, if you're not aware, in the stock market, let's say Apple. Apple is a technology company, right? They're not going to be in the same sector as agriculture, which is not going to be in the same sector as oil, right? Those industries, although maybe sometimes can affect each other, are really unrelated, right? So having a diverse portfolio where your stocks are in different sectors helps to minimize losses, and having a mutual fund or index fund or ETF in which you don't just have a couple stocks, where you have a multitude of stocks, creates this string of protection. So let's say you're in the elevator, and then instead of one cord, now you have 100 cables wrapped around each other, 100 cables. Well, what happens if one of those companies goes under? You know, that one cable snaps. Boom, you feel it. Yeah, you'll notice it, but you're not going to come plummeting down, right? Now, you have all of these other companies that will help minimize the losses, right? So now to go into the difference between an index fund and a mutual fund. And if you're not aware, or if you don't know who Warren Buffett is, he is one of the most successful investors in history. He's a billionaire who's made his money from his approach is to find undervalued companies and then to pour tons of value into those companies and to invest in the right time. But he recommends for people who are not experts at investing, right? If you're not an expert who are spending all your time looking at graphs, understanding the economy and how the economy is affecting businesses and how businesses are being affected within their sector because of competitors, because of upgrading technology, because of pandemics that may be happening. You know, if you're not actively doing that, Warren Buffett suggests you just invest in an index fund. And an index fund is basically a group of funds that pretty much mirror the stock market, right? So the S&P 500 is a very popular index fund, which is the top 500 stocks basically that you can invest in. And so the top 500 stocks, you may not have astronomical gains, but you have a lot of stability overall. So you may not have those astronomical gains, but you will have a lot of stability overall as far as the market goes. And typically right now, the average the stock market has been able to do is about 10% a year, 10% ROI plus or minus per year. So that brings me to mutual funds. Mutual funds are similar to index funds in that they are the risk mitigation strategy is having a multitude of stocks to help keep the portfolio up. Now, the difference is a mutual fund can have what's called a loading fee, which is a certain amount of money, a minimum to get into, and there's a percent fee for management, a management fee that goes with this, and this could be additionally to whatever you pay your financial advisor. So you have to look at the details of that mutual fund specifically. But mutual funds are actively managed, which means that throughout the year, they will be buying and selling stocks to try to maintain the health of that portfolio. Unfortunately, the majority of those funds do not beat the market, meaning if you would have just got an index fund and not paid the fees, you would have done better. You would have netted better at the end. So that's a big like warning, red flag. Okay, so when you go to select a mutual fund, if you decide to take that route, you want to look at the history, right? Look at its performance over 10 years. You want at least 10-year history. If you don't have that much data, if this is a 5-year fund and it's doing amazing, it's 5 years. How did this fund do during the really desperate times or hard times? How did it do during a bad economy? How did it do when, XYZ happened within that technology sector? You get me? You want to weigh out long term, how did the fund perform? Because although past performance does not guarantee future results, past performance is a better indicator that at least the people running the fund have a better concept of how to handle the funds properly, right? So at the end of the day, it comes down to education, understanding how all of this affects you, and understanding that this is still a good long-term wealth building vehicle. There is the retirement version of this, where all of this can be within a tax sheltered account, and then the non-retirement version of this, where it's money outside of your retirement that you're investing for long term, either for real estate or for other investments, or that this is the investment vehicle of your choice. You know, just having money in the stock market, because there's been tons of millionaires who've become millionaires because of the stock market. The majority of millionaires in the U.S. have their paid for home and their retirement savings, and those are the two major asset categories that they have become millionaires. So this is not something that you should take out of your strategy completely. There's still a lot of growth potential here, and of course, keeping your total portfolio diversified is a risk management strategy. So hope this helps. Hope you guys learned some about the stock market. Hope I've convinced you of the value of having a good financial advisor and of having a multitude of different investments in your stock market portfolio. And so ask questions, leave comments, share these videos, get people into the group. Yeah, keep learning and growing.